Greetings, Dr. Jeffrey Scott here. This is my weekend market update for the weekend of September 24th, 2023. There's a shot that this will be up on Saturday, the 23rd. My email address historically is hgsidoc@gmail.com, and I'm going to be moving to jeffrey.scott@topdowntrader.com. Both of those will work for the time being. If you're new to my channel, got a couple requests. One, go subscribe so you helps me feel good about what I'm doing. I'd like to get to 1,000 followers. And then click the little alarm so you get notification when I post these, because they're all over the place with the timing. The other request is in the body in the remarks section. I have a link to the Wealth 365 event. It would do me a great favor for people to register using that link. Costs the same no matter how you register. I don't get any credit or payment if you register on my link, but they do measure how many, and it's such an honor to get to speak there. I like to show that I'm trying to drive attendance. The title, now you know. This is why I heed the Hindy. And we're going to talk a little bit about what we've seen in the market. Obviously, it's been a rather rough week or longer. In fact, longer is the right word because I don't usually post extra videos. And on the 13th, I posted something on YouTube which I called Heed the Hindy. It was really paying homage to one of my mentors, Ian Woodward, and what he taught us about the Hindenburg Omen, and calling out that I was seeing it on multiple platforms. I think the Hindy is playing out as one would expect. Um, you know, it could reverse here, and it still was a valid signal, but we can't see, 1 out of 4 Hindis lead to a very big correction. Let's hope we don't go there. So it's up on YouTube. Just look for Heed the Hindy. And if you don't know the Hindenburg Omen, check it out so next time you'll be aware. This is for educational purposes only. Anything I talk about should be taken in the spirit of education and not investment advice. I am a doctor, not a broker. I'm independent. I paid for the tools that I use, and trading involves risk, and you are solely responsible for any investment decisions you make. I mentioned Wealth 365. This is the link, and I'll put it down below so you don't have to worry about copying it down. It's a great, great program. This is how I first found Wealth Charts and became a customer, which I still am. And then Rob built my stuff in and then built me an awesome scanner to sell to other people. But there'll be at least 60 speakers all day, Monday through Saturday, best prices of the year on a number of products, and just a whole lot of fun. So what wasn't fun was the markets. You can see in yellow are the major indices. The big loser on the week was Russell minus 3.8, the NASDAQ 3.5 to 3.6 down, depending on which you want to count as the Qs or the broader. S&P 500 down 2.9, 2.5 on the NYSE, and the Dow 1.9. Perhaps the biggest disappointment to me is despite the markets trying to rally on Friday, they failed. No surprise. Friday, and by the way, there's a Jewish holiday coming up Monday. But the old adage is you sell Rosh Hashanah, which is 8 days ago or so, and you buy Yom Kippur, which is Monday, so maybe that'll be a stimulus to get us out of the doldrums. As we see over here, the move off the 52-week low is pretty phenomenal still. The laggard is the Russell, which is only up 8.7%. It was a tough week. There's no way of saying it any differently. In fact, if you look at all the S&P sectors, the leader is healthcare was only down 1.5%, and the laggard was discretionary down 6.3%. Now, if you want to know what's really down, look at ARK ETF. Kathy Wood had a rough week, was down 9.8%. And the IBD 50 was down 5%. Small cap growth. A lot of the stocks that high growth stock investors like myself typically trade. Here's Sagar's Q tool. Shows me a number of things. Now on the S&P 1500, which is different than the 500, information technology and energy were actually positive. On the S&P 500, which is 500 stocks, not 15, they were all negative. You could see 83% of the stocks in the S&P 1500 are below their Bollinger Band, below the midline of the Bollinger Band, and 17% are below the bottom of the bands. At some point, stocks do not like to congregate below the Bollinger Bands, and you will see a reversion to the mean. It doesn't have to happen at this level. You look at Friday, 82% of sectors were down, 76% of industry groups, and 63% of stocks. It's hard to believe that the markets opened higher on Friday. If one looks at the market over 5 days, you could see all the sectors were down, 92% of industries were down, and 83% of stocks were down. You've got to be an Olympic champion stock picker to make money picking stocks to the long side. And if you look out even 2 weeks or a month, you could see we've been in a bit of a hurt here. Now, I get excited by 17%, and one could ask the question, does that mean a reversal is imminent? I did check during the day, and there was a period of time during the day. Now, I don't think the clock is right because of the 2-hour time difference that I was flipping back and forth on. But you could see during the day the number of stocks below was actually quite a bit higher. When we look at the major indices, the only one that was up was the Qs. You could see we closed at the bottom of our range, which is bearish. Everything is below their 50-day moving average. IWO, which is small cap growth, and ARKK are both below their 200, just to tell you how weak things are. If you look at a 5-day change, nothing was green. Nothing was green over 5 days. And if you look at new highs and new lows, you could see whether you look at the NYSE or the NASDAQ, those numbers keep getting bigger and bigger. Nothing happens when you're good, when you're below the 200-day moving average and you have massive number of new lows versus new highs. Now, a big driver is clearly rates. You already know that, but you can see on the left the 10-year goes higher, 30-year goes higher, and in yellow, the spider goes lower. Now, I think the debate about the recession, how do you fix an inverted yield curve? It's simple. The short-term rates come down and the long-term rates come down less. Well, that happens when the Fed gets nervous. The Fed is not nervous yet. However, although I keep hearing that credit tightness is worse, it really hasn't moved here. And on the production side, we broke back above the midline or zero line on the Fed Reserve District 3 diffusion index, a measure of industrial production. So mixed at best, and as I said, someday we'll have a recession, not today and not this week. Bad breath, correct. Look at the stocks above the 200 came down, stocks above the 40 came down, 21, 12-week new high, new low came down. But are any of them at a massive extreme where you must get a reversal? Yeah, the short-term 21 is close. So that tells me we could see a bounce, not necessarily a recovery, but at least a little bounce sometime this week. The buckets, as I showed you before, about 17% are below their midline, 83% are, 17% below the lower band, 83% below the midline. And you could see down here is if I look at all the stocks in the stock market versus just the S&P 1500. So this just tells me that the S&P 1500 is stronger than a large index of 8,000 or 9,000 U.S. stocks. Now, I get excited on the buckets when we get a lot of stocks below the Bollinger Bands. But if you're in a bear market, you can get really oversold. So the pie, shows you the number of stocks below the midline in the Bollinger Bands, and the graph tells you the number below the bands. So we're nowhere close to this. So this is just showing you 2007 when the market was really, 2008, where the market was trying to make a low before the ultimate recovery. Hindenburg omens, we won't see one this week, but we had three the prior week. And what's still a problem is the number of new lows versus new highs on the NASDAQ and the NYSE. This I thought was interesting. The markets turned down broadly. On the left, I'm looking at impact based upon um, the stocks in the above $2 and 250,000. Everything is negative, but the closer you got to quality, high yield stocks, the better you did. If I look at the all USA, which is much more than the $2 and 250K, a lot of this, a lot of that is different. You know, there could be a lot of different things in all USA, including probably some ETFs, bond funds, small stocks that are too small for this to count. And you could see they're negative throughout the board except for this funny bump here. So it was a tough week. Know your news and earnings. We're not getting a let up. I know we had GDP last week, but this week we got homes, confidence, jobless, GDP, Fed speak, and the entire personal income complex. So there'll be a lot of more news to help the Fed in understanding do they need to raise again. On earnings, it's light, but look at things like Costco, Paychex, Micron, um, Jabal Circuit, CarMax, Nike. So there's still plenty of action this week, although we're getting near the end of that earnings season. So strong U.S. dollar, rising rates took their toll on the market as the Fed restated again higher rates for longer. Mega caps started their longer weighted sell-off, little rotation into other sectors. Most industry groups and sectors were down on the week. We continue in one of the weakest periods of the market from a presidential cycle as well as a market year. And if rates and the dollar are not a concern, we can always look to the UAW strike and the pending budget battle shutdown in Congress. I took notice of the Hindy signals and raised cash in my long holdings. I told you that on my video. We're getting to a place one might expect a bounce, but frankly, we are no longer in an uptrend. So I'm going to look for the William O'Neill follow-through day, which I want to get before I go long this market. Remember, cash is a position, and sometimes being on the sidelines is better than not. Again, excuse me, sorry for the yawning. I'll be putting this into the remarks section. Really appreciate you linking on it. Here is the Friday action. Starts here. Actually moved up a few pennies, went sideways into the lunch hour, and then the S&P sold off. So it was a weak day in the market, and you're going to see a similar pattern. If I look at the spider, you can see that we've broken down below the triangle. We are heading perhaps down to the 4,200, which is my target, especially since we're sitting on 430. This is a place we could bounce. But if we don't bounce here, I hope we bounce at the 420. And by the time we get there, I think the 200 will be sitting there as well. If I look, and so it was down a bit, as you could see here. Not a lot, but it was still down some on Friday, down 0.22. The Qs had also broken down below their 50. They were up a few pennies on Friday. Not a bullish signal there at all. The diamonds are heading down to test their 200. They were down 0.29. And the Russell failed their 200, and they're probably headed down to test this level here, which is the January low. So all of them are falling pretty hard. The VIX actually had a massive day on Thursday. No surprise, as the market sold off. The VIX was up 15.85%. It kind of had a large range inside bar on Friday, and I expect it to continue going higher. And the other problem is the dollar, which was up a tad, and now you'd have to go back to 2007 to see higher US dollars. If you look at commodities, actually, let me take that back. That's on the rates. On the dollars, I can't remember how far I had to go back to see higher rates. Let's make the dollar bigger, and let's put it on monthly. You'd have to go back pretty far. I was not wrong. You'd have to go back to, this is monthly dollars, and it's back into 2007. And except for this little bump here in November, that's the only resistance we got sitting above us. Now, what's interesting is after this run up is when the market started recovering. So we'll see where the dollar goes. Now, if we look at commodities and we start with gold, strong dollar, it's not going to do much. It actually did have a recovery bounce, but traded near the low of the day, sitting on the 200. Silver recovery bounce, but traded down, sitting on the 200. Oil is sort of putting in a flag. Oil, natural gas is doing nothing, and the 10-year actually was down almost 1% on Friday, but it's still way above where we want it to be, and this is the line in the sand. And again, you have to go back to 2007 to see rates that look anything like ours. Other thing I want to show you is look at as rates have gone up, the spider value to growth. Actually, it's wrong time frame. Let me push that onto daily. You could see that growth actually underperformed. You could see values leading higher as the rates go higher. So next we look at the weekly market timing, and you'll see the update from last week as we're in red for all. So look, Hindenburg Omens, 4 markets with a sell signal. Red bongos everywhere below the 30-period moving average. This is one of those times where I don't mind sitting on my hands, raising cash, and waiting to get the follow-through day to go in. If I look at the sectors, kind of what we saw in stocks and docs during the week, we talked about utilities and staples leading us higher with healthcare, and they did. And energy is continuing to stay high. Technology, industrials, discretionary have all come down. If we go into the scanners, let's look at the heat map. Look at the S&P 500. And what you could see is a mixed day at best, red and green. And this, as you know, was down a teeny weeny bit. Healthcare is one that might make a stand here. Healthcare is much more than biotech, and we'll look at a couple of those names in a few minutes. If we look at Wealth Scanner and we rank them from a bullish perspective, you could see the leading stock is SARK, which goes up when ARKK goes down. It's Contra ETF, dollar, TBF, and then there's a massive drop. It's really hard to get excited to the long side. That said, as we start to approach an area one might expect to bounce, there's a risk to the downside. So to me, I'd rather not take that risk and have raised cash, which I've done. If I go into my CAT scanner, let's look at a couple of things. Let's go into healthcare. Now, you don't have these built into the program. I created them. So healthcare, it's not hard to create them. You just have to populate a list. So CGen had a big gap up. Now, I'm not chasing CGen because CGen is a stock that's, or a company trying to be acquired by Pfizer. I think with the EU or the British lowering the bar on the Activision acquisition by Microsoft, anything that was under acquisition probably bounced. I don't think this is something I play. Elector is one that I actually found interesting. It's got volume, breakout momentum, relative strength, and OBV. It's in the right industry group. The problem is it's just got overhead supply to die from, and it's got to get through a 200. So I'm not a big fan of it. Speaking of overhead supply, this one does look interesting. This is Murati, which has been down for a while. And the reason why I thought it looked interesting is 2 days of massive volume breakouts and momentum. The BAGO went positive, and look at the relative strength in the OBV. Now, if you're astute, you're going to say, but Jeff, the The red line, the high-low oscillator, your measure of extensions at 100, it is. But you got to look at that stock. Is it extended? Well, I guess if you go back 5 days, it probably is extended. But look at how far this thing has come down. But that might be a bottom play that might be interesting. McKesson is a name that's a steady Eddie, like AmerisourceBergen, now with the new ticker Core, Cencor or something is their name. These are distributors that are operational machines, have low margins and high volume. And they're nice defensive plays. You can see it's having a nice move. It's in a nice uptrend, unlike most of the market. Vaxcyte's a small biotech. Is this thing getting ready to break out of a funny looking cup and handle? It's probably worth putting on a watch list. And then United Healthcare, I think we all know who they are. You might have Optum on your physician, your drug card. Has really held up well in the recent pullback. And look at all the green here coming out of a squeeze with relative strength in OBV. So I could be very happy going into any of a number of those. Now, with oil being strong, I might want to look at producers and other energy plays. So I made a large book of energy. And here's an impressive looking energy stock, OBE. It's a small stock. It's an $8 stock, but look at the volume. 4 dots, gap, volume, breakout, momentum, relative strength in OBV. Yes, it's getting extended, but it's well off of its highs. Antero Midstream, this is an MLP, so it pays a dividend. Pullback, sideways play, took out the 50 on good volume with breakout and momentum. ET is one we've talked about before because it's one that I have a position in. Another of the MLP providers. Dividend at a nice high. ARLP is a coal company. And look at that run that that's having. Talk about outperforming the market. Now, I apologize for the swallowing. I get dry mouth when I talk this much. And somebody did complain about it, but hey, a man's got to breathe and talk. And you can see ARLP. A lot of these are extended, and OBE is probably extended as well. Lastly, I could pull into my CAT scan and look at the combo list, my leaders list. And Activision is the one I mentioned that got some good news about acquisition. We already looked at OBE. So a lot of the tankers are starting to look interesting here. I don't think this was my favorite, but you could see a uptrend here on volume, breakout, and momentum. The one that I liked was LG. Was it LPG? Let's see. LPG. Is that Dorian? This is one that I thought was interesting, about to take out this high. Again, massive volume, relative strength, and OBV are supporting it. There's CGen. We looked at ALEC. X is sort of a story play here. I think Cleveland Cliffs put in a takeover offer, so now it's in play. And if you like playing those, it's interesting. Aspen Aerogels. I don't know what this is. I don't like it because it's below the 50, even though it showed up here with 3 dots. Checkpoint is a computer infrastructure play, and that's probably the tightest and most steady uptrend that I've seen in the market right now. So that one's in a beautiful move as well. And going down the list, does anything else pop up to me that I haven't talked with you about? And the answer is no. So what if we look to the short side? Okay, so I could go back. I'm in the combos list. Let's just go to all stocks. And let's look at my bear retracements and a downtrend. So Colgate Palmolive, even though it's a staples, here's a stock that looks like it's breaking down, failed here at the 17. Encore Capital Group. I personally would rather buy Contras than short these, but you can run a reverse of my scans to look at what's breaking down. Talking about the Contra ETFs, just take a look at them very quickly, because I think that if you want to play the market to the downside, that might be the simple way without having individual stock risk. Now, the thing about the Contra ETFs is Contra. They go up when the market goes down. So the dog will go up when the Dow goes down. It's got to get above that 200. That's probably boding decent for the market. Dust will go up when gold goes down. SARK will go up. We talked about this already when ARKK goes down. SDS, again, you got nice little breakouts here, will go up when the S&P goes down, still below the 200. The SPXS is a more levered ETF to the S&P 500. SQQQ is leveraged to the Qs. This will go up when the Qs go down. TZA goes up when small caps go down. This one probably looks the best of the bunch. And then VXX will go up with volatility. So there are ways to play, that's not really a contra ETF, ways to play a falling market without shorting stocks or buying puts. You look at instruments that trade like stocks that go the opposite way of the market. So I can't emphasize enough that this is a challenging time in the market. No one says you have to be invested all the time. There are times to be in, there are times to be out. I think this one is out, and there will be better times ahead. And let's look for that O'Neill follow through day as a signal to get more committed. Have an awesome week. And to my Jewish followers, I hope you have a good Yom Kippur, a good fast. And let's hope the market remembers you buy on Yom Kippur.